I do want to bring in our guest to discuss further on market action. Joining us now is George See., chairman and co-founder of Annandale Capital. George, great to have you with us here today. I do want to start with the NASDAQ. We are seeing big gains today. We've seen Apple's 4-for-1 stock split, Tesla's 5-for-1 stock split go into effect. Shares for both those companies did end the day higher. Should investors have any concern of possible overvaluation and to use maybe stronger language, a bubble burst for names in the big tech space?
Well, for a lot of your viewers, they weren't around for 1999. I started my company in 1998 and lived through 1999 as not a value investor, but a GARP investor, where I wanted to pay a reasonable price for growth. And it's 1999 all over again. I mean, it just is. I mean, you look at Tesla, you look at Apple, you look at Zoom, you look at all these names, and they're absurd. And you look at Tesla, that I think an analyst, when it was in the 200 to 300 range about a year ago, an analyst said that it would go to 5,000 someday. Well, it hit 2,500 today, less than a year later, and is trading at triple-digit price to sales. And they barely have any earnings at all, so probably more like 1,000 times earnings. And you go back to about 6 or 7 years ago in the convention. Well, actually, maybe even 3 or 4 years ago, and the conventional wisdom on Apple was that it was a cyclical business, and cell phones were very uncertain, and your competitive advantage could go away overnight, and it deserved a multiple of about 10, 11, 12 times earnings. Here we are in the high 30s on the multiple today, because it's just such a powerful business, and because they see the super cycle coming in 5G, and it's absurdly overpriced now. So investors need to trim if they own these stocks, and if they want to jump on now and they haven't been on before, I hope they're gamblers, because they're really gambling. And they need to look at some companies that are great businesses that are priced at a fraction of what these big stocks are priced at.
Well, George, it feels like in part this continued excitement over these big tech names is because they've been able to continuously reinvent themselves, whether it's investing more in the cloud space for the Amazons and Googles of the world, or if it's investing more in services now for the Apples of the world. What will it take for a correction? Because as you say, which I find so fascinating, you said it's 1999 all over again. When do you expect to see a correction in tech?
Well, I wish I knew and I could tell everybody and ring the bell so all your viewers could get their money out of the market and watch for a while. But nobody knows when mania's in. They could go on for a long time. If you look at 1994 to 1999, the market went up an average of about 25% a year, and it culminated with 99 when the NASDAQ went up 85%. So this could go on for a long time. But the odds of the NASDAQ being at 11,000 in a couple of years are probably not that good. And the odds of the S&P being over 4,000 in a couple of years, probably not that good either. As a much more distinguished investor than me, Leon Cooperman, said today, basically we have front-loaded 2 to 3 years of returns this year with this incredible surge based on Fed-free money. And the next several years is going to be a lot harder. And if you're in names that are way overpriced, if they trip up even a little bit, or we go into a slowdown and the economy actually shrinks, look out below, because they're going to crash. Whereas if you get stocks that are trading at single-digit multiples of earnings, have safe balance sheets, and pay really high dividends, you're either probably going to keep having gains or you're going to go down a lot less. So it's a good time to play some defense. Don't get out of the market. Don't be too aggressive in selling some of your big winners. But trim a little, take some off the table, and go buy something that makes more sense.
All right, play a little defense. That's a good note there. And George, we obviously saw a whole lot of volatility in the markets in the beginning of the pandemic. It's really leveled off since then, and we continue to see record high after record high. But you've actually said that you expect more volatility going into the election. So as we do get closer and closer to November, what do you expect in terms of volatility, and how should investors take that into mind?
I think that you'll just have wilder swings on the indices going into it instead of smaller days like today where it just doesn't move around a whole lot based on whether people think Biden or Trump are going to win, and whether they think we're going to get the bug under control, or whether we're going to continue to have trouble with the COVID virus. And then also, I think if I were an investor, whether Trump wins or Biden wins, I would be prepared for a sell the news result on the markets. I don't think the markets will be euphoric about a Trump victory. I think they've priced in a lot of performance this year already. And if Biden wins, I think that there will be a sell the news, because everyone who is looking at this with any degree of objectivity knows that Biden is going to be bad for the economy. He may not be bad for the stock market. A lot of Democratic presidents still see the stock market do well during their tenures, but high taxes, more regulation, and anti-business policies in energy and in healthcare and other areas are woefully bad indicators for investors and for Main Street going forward. So just be ready for some more wild moves and don't panic when it happens. And be prepared at the end of the year, we may get a sell-off in reaction to the election.
All right, so if you do expect a sell the news situation for either outcome, Trump or Biden, who do you think would be ultimately better for markets, if not the economy? Who is going to be a better president looking 1 year, 2 years out in terms of how the markets might react?
That's a great question. I'm terrible at predicting that. I think just based on policies alone, Trump is a clear choice to answer that question to. But in terms of the way the history has played out, Democratic presidents have been better for the stock market than Republican presidents. So I don't really know over 1 to 2 years. I think it's going to be hard for the market no matter who wins. And investors really shouldn't make massive decisions or changes in their portfolio based on who they think might win or who actually does get elected. Maybe tweak it a little bit and look at different sectors. Like if Trump wins, you're probably going to want to pivot more towards the energy sector because he's so pro-energy. But counterintuitively, if Biden wins, believe it or not, that's actually really good for energy too. Because with all this focus on green energy or clean energy, you're going to have a lot of pipeline projects shut down or not approved, and you're going to have a lot less supply of commodities because there's going to be so much pressure to not drill on federal lands and do things of this sort. And we all know that reduced supply means we can't meet demand as well, and prices of those commodities are going to go up, which is good for energy companies. So you got to look at things really, really carefully because the markets are more complicated than the average investor would predict, and you've got to keep an open mind and do a lot of research.
Well, given that notion that markets are probably more complicated than ever, how would you advise investors react or trade into or out of any news on vaccine developments, treatment developments, anything that's really COVID related at this point? What's your advice on that?
Yeah, that's a great question. We've already seen such a big surge on, as you mentioned, the stay-at-home stocks and the biotech stocks that are passionately pursuing a vaccine. There's been some sell the news on vaccine development with these companies, so they've already priced in an awful lot of improvements. So I'd be really careful there. I would be more focused on airlines, restaurants, hotels, some of these just under siege industries, cruise lines. When a vaccine is developed, that's kind of ringing the dinner bell on all those industries, and everybody should get out their knife and fork and be ready to dig into a big juicy steak in all those industries because they're going to do a lot better. And you mentioned Zoom a minute ago. It's funny because I'm a GARP investor and I don't like to overpay for things, but I recommended people buy Zoom at 160 because it was obviously such a big winner in this whole situation, and it was going to have momentum for some time to come because we weren't going to have a vaccine soon. And I recommended people sell it at 260, which was too early. I mistimed that because it's gone higher now. But if in a market where you can make 60 to 70% on a company in a month, which is what happened, it's not a bad idea to take some gains or at least use options to protect yourself a little bit.
Yeah, and George, we are going to get to Zoom in a few minutes here, but I do want to understand from you how you would kind of gauge this latest round of earnings from companies. Do they seem to be more or less resilient than you had expected going into this earnings season? Resilience meaning against the pandemic and the resulting recession.
Well, that's another great question. I think it really depends on the industry. If you look at the stay-at-home stocks, they've all performed tremendously. If you look at some of the counterintuitively home improvement stocks like Home Depot, they've performed extremely well too because with rates so low, people have been doing a lot of remodel projects and taking on secondary or primary mortgages to fund construction and all these kind of things. So you just have to really take it on a case by case basis. But earnings overall for industries that have been affected have been truly dreadful. Energy, restaurants, so on and so forth. For industries that are resilient, they've been great. So it's a very bifurcated market right now from that standpoint, just like it's a bifurcated market between really impressive growth stocks and value stocks.
All right, George, thank you so much for your insight today and for your time. That's George C., Chairman and co-founder of Annandale Capital.